Time for an afternoon espresso. Good to see everybody. As you'll see, I'm standing in front of my new background and not sitting in my chair, which means I won't fall asleep. But I want to welcome everybody here to this special live session. I'm going to be talking about the all-weather strategies, but I'm also going to be talking about inflation, interest rates, global economy, the emerging markets relative to developed markets, and I'll have a little bit of discussion about U.S. elections, which are coming soon. So we got a lot of things that we're going to cover today, and as usual, I look forward to getting your questions in the chat, and also just a hello and a welcome. So hello and welcome to everybody. Hope you're having a cup of tea, a cup of coffee, some biscuits, your lunch. Mondays, I do fasting, so I generally only have water and coffee. All right, well, let's get started. I'm going to share my screen, and I'm going to look at what's going on with the all-weather strategies for the month of September. So I'm going to switch my camera over here and talk about this. Remember to ask any questions that you have. I love to get your questions. In fact, when I come out of this section, I want to basically, start answering any of the questions that you may have. Now, remember, our allocations are global, they're long-term, and they're diversified. And why are we here? Well, we all can remember why we're here, and that is to build wealth over the long term. And I see 6 pillars of building wealth, and that is investing in stocks because they have returned much more than bonds and gold. And owning a piece of a company means you get a portion of what the management team creates. And also, number 2, reduce risk. Avoid overexposure to any single asset by spreading your portfolio across various companies, sectors, countries, and asset classes. Number 3, contribute regularly. Reduce stress by applying dollar cost averaging, consistently investing a fixed amount over time. And this takes advantage of volatility and likely lowers costs and enhances long-term returns. Number 4, stay invested. Think long-term, be patient. The benefits of compounding happens over decades. Number 5, maintain discipline. Follow your investment plan to avoid acting based on emotions. And number 6, continue learning. This is the key. You want to deepen your understanding of investing, stay informed about market dynamics, and refine your strategies by learning from successes and failures. Now, we create our strategies for many decades. However, not even a decade is really long term. That's me when I was young. That's me when I moved to Thailand. And that's me when I'm going to be 100. So our aim is to create strategies that perform over many decades. I wrote most of this out in the book, How to Start Building Your Wealth, Investing in the Stock Market. And you can find that at bookstores or at academy.astotz.com for the online course. So our target is to deliver steady returns over the long run. These are our 3 strategies. AWS we launched in February of 2019, and we target 6% per annum. All-weather Alpha Focus we launched in October of 2021, and we target 8% per year. And All-Weather Inflation Guard we launched in July of 2022, and we target 4% again per annum. So from when we started All-Weather Inflation Guard in July of 2022, the strategies are performing almost as expected. We can see that the moderate risk AWS has slightly outperformed All-Weather Alpha Focus. And it can happen, right? There's a lot of volatility, and basically these 2 strategies are very different. But ultimately, the main difference is that Alpha Focus is trying to take more concentrated bets. Now, when those bets work and pay off, it's going to look great. When they're just doing an average performance, it's still going to be pretty darn good. all-weather inflation guard has had the lowest return, but also the lowest volatility, as you can see there with the green line. Now, all strategies have had lower volatility than world equity. And you can see if we plot world equity in there, it's kicking our butt for both all alpha focus as well as all-weather strategy. But I'm willing to forego some of that, right? Because we're mixing asset classes. And that means that sometimes we're going to miss the upside. And I should just draw this line. I think when Alex and I work on this again, I'll draw this line right here and say, look at our performance here. We have missed this upside in the all equity market. But it's important to show that we also miss the downside when it comes. And that's really the objective of what we're trying to do. So now let's look at all-weather strategy. And we can see since inception, the strategy was up 48.1%. And that's 16.5% above a 60-40 portfolio. In September, the strategy was up 1.6%, which was 0.4% above the 60-40 portfolio. Our 25% target allocation to gold did great. Our 25% allocations to U.S. equity and global bonds did okay. And our 5% allocation to China jumped 20%. Incredible. So next, let's look at all-weather alpha focus, which fell 0.4%. You can see strategy was up 3.8% since inception and 4.9% above a 60-40. So from our perspective, on an after fee basis, or our estimate of after fee, alpha focus has still done okay. We just like to see it do better. But we take it one day at a time. So here we can see it's basically 3.1% below world equity, but with a lot less volatility. Remember, we're not trying to beat world equity. What we're trying to do is get close, but with much, much lower volatility. So we've reduced our equity allocation to 68%, which leads to a lag as world equity rose very strong. So we can see the strategy was down 0.4%, which was 1.6% below the 60-40. Our big tilts to gold and infrastructure did well, but our tilt to global bonds did okay, while our tilt to healthcare dragged on performance. Our world equity fund underperformed, which was a drag on performance. So now let's look at all-weather inflation guard. That fell 0.1%. So basically flat. Here we can see since inception, the strategy was up 8.6%, and it's about 4.5% above a 40-60 portfolio. The strategy has also experienced less volatility. Here we can see inflation guard and the global bonds gained about 0.9%. Our 5% allocations to gold and REITs did great, and our world equity fund underperformed, which dragged on performance. So before we continue on with that, I'm going to switch my camera and come back to you and talk for a moment. So that's the performance for the strategies. It was a pretty good month for a great month for all-weather strategy. Alpha focus was flat, and we can see inflation guard was also flat. So let me also welcome everybody who's just arrived. Hopefully you're having a cup of coffee or a cup of tea or a glass of water. I'm enjoying a Coffee Works espresso. And Supercorn says, okay, hold on. Let's look at this. Thank you for adding China. Yeah, actually, I have to say that China was in all-weather strategy, but it was bundled in the Asia ex Japan. And therefore, what we've done is we've gotten China as an individual country now. We still actually can get sometimes exposure to China through emerging markets weighting, and with war may expand and impact to oil, how do you see impact to inflation in the next few months and may impact to rate cuts? Well, I'm gonna Super Gone. If you hang on for just a couple minutes, I'm gonna go into my my presentation on global inflation and interest rates. So, all right. So now I'll go through that and I'll give you my perspective on that. So, Chalumpat says, what's your view on China based on your FVMR model? Well, obviously, momentum is the key factor driving the Chinese market. You can also say valuation, but remember the Chinese market is 30% banks, and the valuation of banks is low, and it's probably not going to, there's a lot of risk in the bank sector. So I would say momentum is the main driver that's made China attractive right now. Valuation is there, but the overall market is still a bit expensive. Once we take out the bank sector, still a little bit expensive, but I would say its valuation is probably neutral at this point. Proet Champ says, if we receive a year-end bonus, should we do the DCA equally every month throughout 2025, or should we divide the money into portions and gradually find opportunities to invest? So what you're talking about here, Champ, is lump sum contribution versus monthly contribution. And the easiest way to answer this question is this. If we knew, let's just say that we knew that 2025 was going to be a great year. Let's just say we knew that. Market's going to go up 10, 15, 20% in 2025. Then we would want to contribute a lump sum at the beginning of the year. And then we'd have our money exposed to that rise in the market, and we'd get the much better gain than if we were doing DCA, where we are putting equal amount into the market every month. So it's important to remember that DCA is not superior to lump sum investing if we're investing when the market is cheap and the market goes up. But the problem with this, Champ, is that we don't know what's going to happen with the US market or with global markets at all in 2025. And that's the reason why DCA makes sense for most investors, is because trying to time the market is very difficult. And if you get it wrong, then you're not going to have the right exposure. Now, the other thing that I would mention, Champ, is this. Academic research in America and professional research that's done in America shows that the typical investor damages their return by using market timing by between 2 and 4%. What that means is the average investor, they could be getting, let's say, 10% return every year over a long period of time, averaged out, but they get only 6 or 7 or 8% because of their bad timing. So the answer to your question, in my opinion, is DCA. All right, you can ask more questions if that left some questions in your mind. Boonlert says, why is a 10-year bond yield jump to 4% and what's the outlook? Well, remember that the 10-year bond is a function of two things. Number one, the market's expectation on growth, GDP growth, the growth in the economy, the growth in the markets. And the second one is the market's expectation on inflation. Usually when the bond yield jumps, it's because people's perception of growth and or inflation is rising. And so the result is the jump in the 10-year bond has come because people are seeing that interest rates are coming down, and maybe they're thinking, number one, that the economy is going to do well, in the long run. And that could be part of what's happening, is their expectations for growth in the economy is rising. The second thing that they may think, some people may think that, in fact, inflation is coming back and the Fed reducing interest rates causing inflation fears to come back. So those are the two main reasons. Now, there is supply and demand factors, and it's important to note that the main buyer for U.S. government bonds these days is the Fed. So the market can be distorted, but those are the two main drivers, the growth and inflation. And in this case, investors are expecting those to rise recently. All right, great questions. And please keep your questions coming. I'm going to have another sip of my coffee. Now you notice I got a new background. I set up at my new office and I've got all of my favorite stuff. But this one, of course, my favorite is my monkey. This is my Curious George monkey. And my mom gave that to me when I was a baby. And so that doll is just about as old as me. And that's pretty old. All right, let's continue on. I'm going to go back into the presentation. And let's continue on. Here's where it's going to get fun. We're going to look at global inflation and interest rates. So here, what we can see is inflation, of course, spiked during the COVID time, and now it's down to 3.8%. And basically, we're calculating this inflation rate, this world inflation rate ourselves by looking at the GDP per country, and then after that, weighting each country's inflation. So it could be, for instance, that Egypt has a lot of inflation, but the GDP is very small. So in the calculation, it's a small element. 60% or so of the weighting, of course, is going to be the US. So now inflation has fallen quicker in developed markets. So developed markets are the red line and the blue line are emerging markets. And what you can see is this spike that happened from COVID continues on in the emerging markets. It's like the cost of the COVID lockdowns were brutal for emerging markets. Just look at Kenya as an example, where they had interest rates go through the roof. They had the cost inflation go through the roof. They had the cost of fertilizer and gas and wheat. All of these things went through the roof, and they haven't come down. And whereas we can see that they've come down in the developed markets. So in a cruel irony, the shutdowns by COVID hurt the emerging markets much more. And now they're struggling with 6% or so inflation. So inflation has come down in the US, but more sticky recently. It's harder to get inflation down at this point. And if we look at China, China's fascinating because basically since the COVID lockdowns, China was in a very, very low inflationary situation. And it still is. But if we just look at what happened during COVID, you can see that there wasn't as much money pumped into the Chinese economy as there was the US economy. And therefore, the crash came smaller. And now we're sitting here at this period where inflation actually is falling in the US and rising now in China. So Germany inflation has fallen faster than the US. Germany's just collapsing, basically. And it's amazing what's happening there, but it's really terrifying because the German economy is the engine of Europe. And I think that there's a huge risk in the German economy. And here we can see that UK inflation has also dropped rapidly. Now, UK inflation shot up much higher than what we saw in the US. And one of the things to keep in mind is that the UK has their own currency, like the US, unlike countries in the Eurozone. And the result of that is that the adjustments to inflation and the currency can get pretty massive there. So let's look at Japan. Here we can see finally we got some increase in inflation in Japan. And that's part of what that rise in inflation started to push up the markets in Japan. And now, let's now look at the government bond yields. So now I'm going to switch from inflation to government bond yields. And here we have the 3-month government bond yield. And what we can see is that the yield really shot up, of course. And then what happened was we started to see the yield go down. And here we see the Fed tightening, basically starting at this point. So it's fallen to 5.2% from 6% a year ago. And rates came up quickly. Inflation has come down and rates have fallen just a bit. And I'm expecting continued lowering of rates in the US. I still think this is crazy, but here's what I still think. I still think that this interest rate item here is going to come down close to zero pretty fast. So 3-month government bond yields have fallen in both worlds. What we can see is a pretty significant fall here in the emerging markets once the Fed started loosening, but still at a very high level in the emerging markets. Now, the Fed just recently started cutting rates, and US is about 60% or so of the world that we looked at earlier. And when you see rate cuts, the Fed always wants to cut slowly. Here you can see slow and then boom. And I suspect that this is part of our slow, and then I'm expecting boom. So I think it's very possible that interest rates in America come back down to zero as they were in the past. One of the reasons why is because if we get into an a recessionary environment, the Fed's going to be encouraged to cut rates. Also, if Donald Trump comes in, but whichever politician's in there, they're going to want interest rates to go down to zero. Now, China basically never raised rates. You can see, in fact, the Chinese rates have been on a long down cycle for 3-month rates, and they've just been flat all this time. Again, there was much less of a flood of liquidity going into the Chinese market. And so the result of that is that the Chinese government bond yield for 3 months, remember, I'm looking at 3-month government bond yield up here in the upper left-hand corner, went down slowly. China has tried to stimulate its economy, but by both keeping rates low and fiscal stimulus, but it's not really having a huge impact on the Chinese economy. So Germany went from negative yields up into positive and now coming back down. Germany has followed the trajectory of the US since the rate hikes started. And here we can see UK has tracked the US in its hiking cycle. And finally, there's Japan. So yes, there's been an increase in Japanese rates, but if you look at the actual amount here, it is tiny. So that gives you a picture of what's happening. So before I go further, let me just come back to any questions. I'm going to just come back to my other camera for a second. So what you can get from this is, what you can see is that inflation's coming down quite a bit and interest rates are coming down quite a bit. You've also heard from me that I still think that we're going to see US interest rates going back down to zero at some point in the future when the Fed ends up having to stimulate the economy. All right. Supergon asks the question, what are the key factors you're focusing on in this couple of months which may impact to the portfolio asset allocations? I would say the biggest impact is the election, the US election. And I'm going to talk a little bit about that in a second. But by the way, Supercorn, did this give you some indications about what I'm looking at as far as CPI and the like? I didn't mention about oil price, but oil's fascinating. And if we go into a recessionary period, the price of oil will fall. But one thing's for sure, the US has been cranking oil. The Biden administration has been cranking out oil and natural gas. And so that's been one of the things that's caused a surplus in the market, and therefore oil prices coming down. Okay, let's continue on. Remember, if you have any questions, feel free to ask those questions in the chat, and I'm going to be happy to answer them. Now, let's dig into the yield curve for a moment, and let's go to the next page. We can see we're looking at 3 different periods of time of the world government bond yield curve. The first period is the red line, where we can see the yield curve was flat. The second is 2023, which is the blue line, where we can see that the yield curve was high and normal, let's say. And what we can see recently is that the yield curve is normal. The world yield curve is normal, meaning short term is higher than long term, but it's been coming down. Now, if we look at developed markets, it gets a little bit more interesting. And in developed markets, what we can see is that those yield curves. So I'm going to go back up to the slide before. This is 6% for world. And here we can see that for the developed markets, we can see that that yield curve is very, very flat now in the developed markets. And the emerging markets yield curves are much higher. And we can see that they are normal in the sense that the blue and the green lines are downward sloping, but still very high interest rates. These are government bond rates. That's the important thing to note here, government bond rates. So US, now we're going to be looking at the US. What is going on with US yield curves? And this is the US government bond yield curve. And we can see US yields have dropped significantly as the Fed has cut the policy rate. So generally the curve is flat, let's say, and has shifted down as interest rates have gone down all across the curve. Now, China has continued to push down rates. We can see that in 2024, in September of this year, rates are considerably lower, about half almost of what they were in 2019. So lower rates to continue to try to stimulate the economy. German yields have started to fall also. We can see they were negative, and now the yield curve is flat and it's falling. Steel yields are way above the negative yields that we saw 5 years ago. Kind of crazy to go back in time and think about how basically you had to pay the government to borrow from them in those days. UK yields have come down a bit as well, as we can see a slight fall in those yields. And Japanese yields have come up a bit, and the whole yield curve is now positive. You could see that the 2019, the Japanese yield curve was pretty flat, almost zero all the way across. But basically what happened in 2023 is that the curve started going back to normal. Remember, an upward sloping yield curve is normal. And to see Japanese 30-year bonds, 20-year bonds, and even 10-year bonds at 10% at 1% shows it's been a major policy shift in Japan. So what's next? Inflationary pressures have eased, and US and Europe have started to cut rates. China is trying to stimulate its economy. Japan has started to raise rates, and the West is likely to continue to cut. China remains low or cut, while Japan may raise further. That gives you a picture of interest rates. I'm going to come back and talk to you for a couple of minutes before we go into the next section. And the next section is about what's happening with the Fed funds rate and the Fed policies. I want to welcome everybody here. We've got 220 people, and hopefully you can ask any question you want. Feel free. Hopefully we'll get 220 questions. Maybe not, but let's get to the next questions, right? Let's see. Supergone says, from your FEMR model, what is the most important to consider for allocation? I would say momentum is a huge one because, as an analyst, we can't catch everything. And so momentum factor is catching where the market is, where other analysts are seeing things happening and it's being reflected in the market. So momentum's definitely a significant factor. I would also say that valuation is a significant one. So if I was to just pick two, I would say valuation and momentum. How do you view to make Indonesia one for a country asset allocation? Generally what I'm trying to do in all-weather strategy is not have country allocations, except if the countries are huge. So US, Japan, and China. Outside of that, even though let's say India is a huge economy, it's not a huge market capitalization market. And remember, I'm benchmarking against the 60-40 portfolio. And so I don't want to do something that just completely goes against that. Now in Alpha Focus, we do take more country bets and sector bets and the like. And so therefore, Indonesia could be one that we consider for Alpha Focus. But for all-weather strategy, we're only going to look at the biggest countries when it comes to country exposure. Good question, though. Pitt, what is your perspective of China market after rising high above 20% last week from their government policy? I think it's, the market was, super cheap for sure. And I think that there's nothing wrong with, I'm happy to see that market come up because it's been beaten so badly. The real question is, can it sustain that? And I would say no. I think it was just unusually low and everybody got excited. Now, I think China, I haven't looked at the foreign flows into China, but I believe that Chinese people don't trust the Chinese market so much these days. So I wonder where the money came from that pushed up the market. I haven't seen that data, but maybe if you've seen that data, let me know. Part of what I'm concerned about is that the U.S., particularly the Biden administration, is on a war footing with China. And the result is they're trying to do everything they can to try to keep the Chinese economy down and keep capital inflows from coming into China. And I think that is a longer term problem for the Chinese market, because if there's not a huge amount of inflows into the Chinese market, then it would be, it would be hard for the market to really bounce from here. I would say though, that, if there was no tension between the US and China, and the US was encouraging a free flow of capital into China, I think the market would be in a much, much higher level. But I just think that the geopolitical issues are so significant that I just don't see that Chinese market having a sustained run. Part of the reason why I got China out of Asia ex Japan for our Asia ex Japan ex China is that I was concerned about that. So now we have China as a separate asset class that I can increase or decrease based upon how I feel about it. But that's my answer to the question. And that is, I don't think it's a long-term uptrend. I think it's just a good, strong recovery from a disastrous level, and maybe it'll stay at this level, but the idea that it will go up a lot from here, I doubt. All right. Keep your questions coming. These are good questions. And the next question comes from Boone Lert. Recently, market talks about no landing. Is it still a good time to invest in corporate bonds and SC Globe? Yeah, in fact, I'm going to show you something on SC Globe in a chart coming up, Boone Lert. So take a look at that. I think it's a good time to invest in bonds in general. Let's just say government bonds first, because interest rates are coming down. And when interest rates are coming down, existing bonds are more attractive. And so you tend to get outperformance in the bonds that you're holding in a fall in interest rates. So definitely bonds are attractive. Now, as far as corporate bonds are concerned, you have to ask the question, if the economy weakens, if interest rates come down very low, is the quality of corporate bonds stronger or weaker? And I would say there is some risk in corporate bonds. So for our strategies, we don't do a lot of corporate bonds. It's mainly government bonds, particularly with all weather and inflation guard. All right, let's go back to the presentation, and I'm going to flip back over and we're going to continue on with this discussion. So here we can see that the Fed has held rates high for a long period already. It's 14 months. This time the Fed held the peak for 14 months before cutting, and only building up to the global financial crisis did the Fed hold the peak rate for longer, and that was 15 months. And what we can see is basically most of the time when the Fed has started to cut rates, recession has followed. We can see check, cut rates, recession followed, check, cut rates, inflation followed, cut rates, inflation followed, cut rates, inflation followed. So why would this time be any different? I don't think it will be. I think we still are going to face a recessionary time. Here we can see yield curve inversion has dived deeper, and the turn has historically signaled a recession. All recessions in the US since 1968 were preceded by an inverted yield curve. Now, this one's lasted a lot longer than others, and I have to give a tip of the hat to what's his name, the guy who came up with the yield curve, Campbell. Basically, he said that maybe this time it's not signaling a recession. And so far, we haven't seen the recession, but I'm not going to bet against that. The average time from inversion until the recession started was about a year. Well, we're past that now. So will this time be different? I think we still have a high risk of recession coming. Now, the market has started to expect faster and steeper cuts from the Fed, as we can see here in the range, and the falling from August just to October has already been about 2 percentage points or 0.2 percentage points. So I think this is a sign of a weaker global economic outlook, and together with ongoing geopolitical conflicts, I'm defensive with our overall equity allocation. Now, I think global bonds could benefit from falling interest rates. So Pitt or Boonler, you were asking about corporate bonds and bonds in general, and I would say that they're going to benefit from this. Only the Bank of Japan is expected to raise rates slowly, but still it's extremely loose in Japan. We have high allocations to global bonds in all 3 strategies. Now, this is so Boonler, this is your question related to SCB Global here, and that's this fund. And what we've done is done a 250-day rolling correlation between global SCB Global and world equity. And what we can see here is that the correlation to world equity has fallen recently. That's generally what we want to see is a low or negative correlation. In fact, if you look at government bonds generally, what we see is a negative correlation. So I would say it's still a very attractive fund at this point. So this is one reason the U.S. must lower interest rates. The debt to GDP now is incredibly massive. And at high rates, the debt service is extremely costly to the American people. Central banks have loaded up on gold, maybe switching from US dollar. We can see here global central bank gold holdings, and we can see US debt held by foreign central banks. So they're getting out of dollars and into gold. And here can see, was it Russia's invasion of Ukraine in February 2022 that got central banks to load up on gold? Well, the total demand from central banks and other institutions was almost as great as in the 5 preceding years. So now first half, we're at about 500. So we're on track for, let's say, if things go according to the way they've been, maybe we're going to see gold coming up to about 1,000 metric tons accumulated by the central banks and other institutions. So it's still strong demand for gold. I'm expecting central bank demand just to remain strong. Now, gold protects value in times of uncertainty and market downturns. It's been an incredible run for gold, for sure. It's typically a safe haven in times of geopolitical tensions and financial turmoil. And rising government debt in major economies can raise concerns about credit quality and stimulate the gold price. That is just an amazing rise. When you look at gold here, having this rise first and then this rise is almost straight up. Incredible performance for gold. Gold has strong momentum. It's above its 50-day and its 200-day moving average. So again, going back to the question that you asked me, Kunsupakon, you said, what's the most important to consider for allocation? Well, one of the big ones here you can see is momentum. And generally, momentum can be very helpful, but we also have to be very careful not to get caught at the peak. So based on the previously mentioned reasons, gold has gained momentum, and I think it can continue. And we'll also like to keep gold as insurance in case the markets go down. So we have gold allocations in all 3 strategies. Time to talk about politics. But before we do, let me come back to you and talk a little bit about any questions about gold, the Fed, and interest rates and the like. So let's see what we see. Any other questions? Chart says, what is your view on Korean equities? You know, Korea is interesting. I wrote a piece a long time ago about the Korean discount. Basically, the main thing, Chart, to remember is that Korea is always cheap. So never go into Korea thinking that it's cheap and it's going to fly, because it remains cheap. And part of the reason why it remains cheap is because of the control of the chaebols and the family groups. And the second thing is that the return on equity has been a disaster. Now, the Korean stock exchange is trying to push the companies. And so we will see some rise like we're seeing in Japanese market, but they're both, Japan and Korea, both suffer from the issue of very low returns. In fact, I just gave a speech to a group of Japanese investors on valuation, and we were just talking about, they were asking me, what discount should we put on cash? So let's say we value a business at 100, and then there's 20 in cash. We would normally add that cash on top and say that this company's worth 120. But they're saying, well, should we discount that cash? Maybe that cash is only worth 15, or maybe that cash is only worth 5. And the reason why they're saying discount is because you're implying that if that cash is in a Japanese company, or maybe even a Korean company, but right now let's talk about Japanese, that cash would just remain. It would not be deployed. So there'd be excess cash sitting on the balance sheet of Japanese companies, and it would remain on the balance sheet of those Japanese companies. And therefore, all that you could expect to earn on it is about 1% or so or less. So that was interesting. Now, I see cash as cash. I don't make a discount, but this just explains a little bit about what's holding down the Japanese market, as well as Korean market to some extent. Pitt, regarding to previous question, what will be the reason or a factor that you may consider to add China market in your portfolio? Well, China is now 5% of our strategy at this point. And I would say we're going to re-look at all the strategy in 2 months. And when I do, it could be that the Chinese market momentum is continuing, and then I decide to switch into that and capture more of that momentum and increase the weighting from 5 to 10% or the like. Or we could see the Chinese market falling. But remember, Pitt, I don't make any changes in between my quarterly rebalances. And part of that is because I spend so much time trying to make my allocations that I want to be careful and let my allocations run for 3 months. All right, let me continue. I'm going to go back into the presentation here. Hold on. So, politics. Now, before I talk about politics, I just want to mention that we've got Valuation Masterclass Bootcamp number 18 starting on November 4th. So we help finance professionals become valuation experts in months rather than years. And we have many previous attendees coming from Phenomena, like Chachada as an example, Tosapon as an example, Takon, and also Jutamas, who's a former client of Phenomena and still hopefully a client at Phenomena, and Boon Sim and Pongsakon as an example. Now, in the Valuation Masterclass Bootcamp, you get a 6-week guided intensive online valuation bootcamp. We have daily live sessions, team support, progress tracking, and you end up writing and presenting a professional valuation report on a company. In fact, right after this, I'm going to be listening to a presentation from one of the graduates. You get an extra $100 off at any price point because you're from Phenomena. So use this coupon code Phenomena and just go to valuationmasterclass.com/bootcamp or scan the QR code. All right. So now let's go back and talk about, I'm just going to shoot back up here and go to this great picture. There it is. Donald Trump and Kamala Harris. The showdown is about to happen. So let me talk a little bit about U.S. politics now. And my forecast for U.S. politics from about a year to a year and a half ago was Gavin Newsom against Donald Trump, and Gavin Newsom would win. And this I was saying because although Trump has gained in popularity, I think that the Democrat Party, the stakes are too high. They'll do anything at this point to stop Trump. And so my perspective is that if it was an absolute free and fair election, that Trump would probably win by a small margin. But I would argue that the Democrat Party has very strong control of the media, number one. So majority of the media that people are absorbing and getting is controlled by the Democrat Party and is in support, let's say, of the Democrat Party. The second thing is the Democrat Party has clearly become the party of big business. they switched from being the party of the working person to big business. And in particular, those businesses are media, social media, search, and those items. And I believe that their control of the message through those channels is still very powerful. You've already had Mark Zuckerberg come out and apologize for basically being a pawn of the Democrat Party in the past. You also have some great research done by a guy named Dr. Epstein, which is showing how Google is trying to manipulate people, which, you know, Google, that's part of what they do. But so my argument is that the stakes are too high for the Democrat Party. They cannot let Donald Trump win. Now, I think they would have done a lot better with Gavin Newsom because he has real executive experience. I don't like his policies in California at all, but I think that he has the real experience. The problem that Kamala Harris has is that she really doesn't have any experience in leading. Now, that shouldn't be a major impediment in the US because Barack Obama really had the same level of experience. He was a senator, she was a senator for a while, and that's it. It's not like they ran a city or they ran a state. So they don't have executive experience. So executive experience in the case of Kamala Harris doesn't really look good. So my pick right now is that in the end, Kamala Harris is likely to win. And if that happens, what we're going to see, I believe, is it's going to hurt the market, particularly because people are going to perceive that it's going to be more spending that's going to be happening. Now, I would say it's a 40% chance that Trump wins. And if Trump wins, I think people are going, the market's going to probably fly because people are going to expect that it's much more lower taxes and also more beneficial for companies. And the problem that you face now is that the Republicans are just as bad as the Democrats nowadays for spending. So both parties will continue to spend into oblivion. And the result of that is that the US dollar eventually will fall in its value. But for right now, that's the way I'm looking at it. Now, it is pretty amazing what's happening in the US. It's the first time in my lifetime that I've seen a presidential candidate building a coalition before the election. Normally, we're pretty used to that in parliamentary systems like Thailand, as an example, where the prime minister comes from a coalition of MPs. But in America, it's very different. It's normally a single president going out representing their party. But to see that Donald Trump is bringing Robert F. Kennedy Jr. and Tulsi Gabbard, both of them former Democrat Party members, bringing them into his team and announcing that from the beginning is an interesting one. And I think that Robert F. Kennedy Jr. has a huge amount of following. And so if Trump was to win, as I said, if it was like completely free and fair, let's say that the US did elections like Thailand. Thailand elections are pretty simple. On the day of election, which is normally, I think, on a weekend, let's say a Sunday, on the day of the election, in fact, what you do is you just walk down or drive down to the election location. They have your name. You go down a list. You click off your name. You take your ID card. You show them. They tick off your name. They give you a ballot. You go in. You cast your ballot. And then they add up those ballots in that one district. And then they pass that on. And then by the end of the day, they have the count. If America was so sophisticated as to count its votes just like that, I think Trump would win. And I think that the Robert F. Kennedy Jr. votes would be the thing that would bring Trump over the line. But that's not how the U.S. votes. They mail in ballots. They don't require ID for ballots in California, I believe now. I saw Elon Musk saying that. It's kind of unbelievable. But I do know that that it's common for Democrat Party members to try to prevent people from having to use ID when they're voting. And if they can be successful in that, I think that, it's going to be interesting. Now, there is a case in the U.S., in Philadelphia or in Pennsylvania, where 5 senators, I think it was, that are competing in Pennsylvania have filed charges against the the legislature, I think it is, of Pennsylvania. And what the conclusion of that was that the case, the allegations in that case is that the Pennsylvania legislature is coming up with rules where it's not requiring an ID for overseas voters, particularly military overseas voters. And they're arguing that that is unfair. If anybody can vote without an ID, then there's no control of the election process. Anyways, that's my opinion as of right now about the election, and that is Trump unlikely to win because Democrats, the cost to the Democrat Party is too disastrous, and they have all the means at their disposal to control the situation, and therefore Trump is likely to lose and Harris is likely to win. If Harris wins, I would predict that the U.S. market goes down. And if Trump wins, I would predict that the U.S. market goes up. And I think that if we do get a huge vote, let's say from Robert F. Kennedy Jr.'s votes, we could see that Trump could win. But it's a matter of how do you control that as best that the Democrat Party can, I think, in this election. So I think we've gotten through all of what I wanted to talk about, and we've gotten through your questions. Hopefully that's a good update on all-weather strategy and all-weather alpha focus and all-weather inflation guard. I want to thank you for following the all-weather strategies, and I want to thank FINNOMENA for being such a great partner and really bringing out what we're doing with these strategies. It's been exciting. Remember, if you've got any questions about your strategy or your investments, talk to FINNOMENA advisors. Remember, I'm not your advisor. I'm advising FINNOMENA and providing them with basically third-party research to try to help them in their allocations. But reach out to your advisor if you've got specific questions about your taxes, about your strategies, about all of that thing, because I don't know anything about that stuff. I just know about allocations. We now have 265 people on this call. And I just want to say thank you so much to everybody for listening in. And if you've got questions, feel free to ask them. But also, if you've got things that you'd like me to address, feel free to let me know and let FINNOMENA team know. And the one last thing I would say with all of these 270 people now on this call, come and meet me. In about 2 months, I'll be at FINNOMENA doing a live presentation of the rebalance of the portfolio. So Pitt, Boonler, Chat, and Supercorn and others, all of you out there, let's sit down, let's talk, let's look at the strategy, let's go through it. I can't wait to get back to FINNOMENA. We had about 60 or so people in the last event, and for the next rebalance, it should be even more. It's going to be a fascinating time. Let's get to know each other and let's go through any questions that you have. Meanwhile, I want to thank you all for spending this Monday afternoon with me. I'm going to go sip some coffee with my mother, relax a little bit, and then get back to work. And then tonight we have the valuation masterclass. Have a great day and a great week ahead, and I'll see you in 1 month.